Joining us more now is Mark Gardner from MPC Markets. Mark, happy Monday to you. Of course, in the wash-up of such an eventful week last week. All about that Trump trade, which look largely seen as benefiting US stocks, maybe not more globally though.
Yeah, look, I mean, obviously a little bit of a dose of patriotism going through the US markets, and obviously we saw Bitcoin hit 80,000 over the weekend as well. So, but look, we started to see a little bit of buying come back into. Obviously, the Russell had that huge move in the small caps, up around 7% in a single session. But yeah, I don't know whether this will necessarily dissipate until the January 20 inauguration. Really, we're probably set to grind higher at this stage because, while we've got a certainty around, Trump being the next president and the transition of the three branches of government to the Republicans, there won't be a lot to go on. I wouldn't have thought until then that's really going to rock the boat too much. So yeah, we've got a couple of wrecks in the small cap. One sort of outside the US, which is Findy or Findy. FND, which was in one of our recommendations for the small caps big ideas.
One that's exposure to India.
India, yeah, but it's really one of the only, India's got that demographic where it's got one of the only growing workforces for the next sort of 20 or 30 years. So if you want to exposure out of the US because you're a little bit worried, then that one's probably not a bad one, but obviously exposure to the US and would be John's Lynn Group, JLG, which there's around about 200 odd billion now is the estimated cost minimum of the hurricane damage, and they're in looking a little bit deeper, they're close relationships with all the insurers in the US, particularly up that east coast where the where the hurricanes hit. They're probably in for an enormous backlog of work, and really the only reason that things dropped down here is lack of catastrophes. Well, we just had very, very expensive ones, so we would expect them to report extraordinarily well come next February, March.
So, Mark, how do you see this playing out? You say the Trump trade likely to continue until this inauguration, which is mid-January. What of, though, the local market? And we look at, obviously, the sugar hit that's had to the States, but the same really can't be said of what we're seeing locally.
No, I think we were all eyes on China, and we're probably a little bit nervous about the fact that Trump talking a big game about tariffs, etc., could damage the Chinese economy. We had the stimulus announcement over the weekend, which, whilst it was an enormous amount of money, really just looked like a bit of a refinancing for the local governments over there, which will have a great effect for the economy, but it's just going to be a slower burn. Obviously, those guys, those local governments getting much cheaper rates, etc. The stimulus will be a little bit more, a little bit slower to come into the economy, I guess. But but it's not your traditional stimulus, which, from an economic standpoint, I totally agree with, but from the market standpoint, it's a little bit disappointing. So materials will probably be a little bit, drift off a little bit today, I would imagine, and that'll weigh the market down a bit.
Well, in fact, we saw that on Friday. Copper tumbled, iron ore was off as well. So you expect that pressure to continue then? Yeah,
I expect that pressure to continue, but I mean, as we've seen, both of those commodities bounce pretty quickly on the smell of any further stimulus. I think we hit rock bottom in that Chinese market probably 6 to 12 months ago. I think now we're stimulating out. I think the restructuring of the local government's finances is a very good long-term fix, and I think overall Trump will. Like I said, he talks a massive game, but I dare say that. They'll come to some sort of reasonable arrangement at some stage. I think, but it's about less than 1 in 10 things he actually says that actually goes through. So, but he just knows that his base loves, the spear rattling. So, whether there's actually anything going to happen or a trade war happen, I highly doubt it.
Mark, another commodity that's come under pressure since the election result has been gold, obviously with the rising US dollar. How are you playing that at the moment?
We're in the gold miners, this mainly because the gold price essentially is, if you have versus with the gold miners, and their margin from ASX is at historical lows essentially. So we see the value in the miners overall, particularly Newmont at the moment. I think it's been a little bit unfairly hit but then that's been doubled down on because we had the first slip back in gold in nearly 7 or 8 months. But from a commodity price point of view, buying around 2,600, which is about $80 away, is probably the first level to start buying back into the physical gold. You can use ETFs like NUG. But at the moment, our pick is probably more Newmont as it stands, and just watch obviously watch these profit margins elevate over the next few earnings for the gold miners overall, because they are making a lot of money.
And data-wise, what are you watching for this week? We've got inflation out of the States. What about locally?
Locally, wage price index, not historically a very volatile number. So obviously we've got consumer sentiment NAB tomorrow, I believe, and but I mean realistically, I think we've got a UBS conference today as well. So there might be some commentary out of that may move certain sectors of the market. But I don't see. I think there'll be more, continued watching of the Chinese, and if any more stimulus comes out. I don't think there's anything expected this week, but the Chinese sort of march to their own beat. So, but apart from that, I think it's probably a little bit of a breather after last week's volatility.